Good day, students. Once again, I am now about to do question 7 on capital budgeting, and I want to bring this across or inform you that it is very important to do comparison of questions, because I did free score, which is question number 9 in the same question bank, and Frisco, which is on my page 17. I just want to show you some of the things that I will also perhaps compare with. I will use partly some of this exercise to compare. If you have watched my video on this question, please, you will see when I'm explaining the differences between the two. Because very importantly in this question, which is the one that I'm not doing now, which I did it already, is the capital allowance that was given, meaning wear and tear, that was given at the reducing balance method, and that capital allowance was 25% reducing balance method. And this was the trick in this question, very important trick that you needed to be mindful of. And secondly, there was also a 1 year payment of tax in arrears. Those were the two very important things that I to some extent recognize that I made a mistake a bit later on. Then now I will also remind you of those differences or similarities or comparison between the two exercises as I'm explaining this question 7 semtors out of 50 marks, also on capital budgeting. And I think this will be the last question that I'll be doing, because it also covers for some dimension in capital budgeting, including the working capital that is introduced at the beginning of the period and recovered or recouped at the end of the accounting period, or at the end, in fact, of the project period. So now it's my culture to start with the requirements, though I don't do it regularly, that I am required to advise Sam if he should invest in the new business venture. Show all calculations. And the minute you are advising, there should be NPV calculation, and you don't just advise using the words. You first use the calculations, then from the calculations you conclude with the words. You don't just say no because of this, then you discuss. No, it is calculation, then after bring theory into calculation into perspective. Now it says Sam is in the hospitality industry and wants to take on a new business venture, and he is investigating starting his own tour operating business, trading as Sam Tours, which will provide customers with 4x4 Sarafi game drive at luxury lounges in Africa. So this is not just any hotels, but luxury lounges in Africa. Sam will need and obviously if these are luxury, then now this also comes into the theory part of this question, where now you are to consider the non-financial factors. Then it says Sam will need to purchase the 4x4 to the amount of 450,000. So now this is the initial investment. Now I'm doing this a bit different. I record as I'm proceeding. So now this will be 450,000 initial cash invested in year 0. So that will be my initial investment. I already drew the table before. Then the following information is relevant for this project. Initial working capital, and I always say this to remind you that if there is working capital or initial working capital, that initial working capital must be recovered or recouped at the end of the useful life of the project. So now the working capital of 50,000, which I will abbreviate as working capital, it is cash that is introduced at the beginning of the project, but at the end of the useful life, the 50,000 must always be recovered. You just record that as is, because you have introduced this capital so that the business can operate. So now when you make a profit, what you invested as capital will be recovered as working capital, will be recovered at the end of the useful life of the project. So it's negative in year 0 and positive at the end of the useful life of the project. Then now we go to the next information that is provided to us. It says that The total expected tours per year is 60. So there are 60 tours. There is no clause of increasing the number of tours per year. Price per person per game drive is 250. Then it says average number of people in the game drive is 12. So there will be 12 people in one game drive, and that will be out of the 16 total, and each person is paying 250. So now when we want to know the total for the game drive, it will be 60 times by 250 times by 12, and this will give us the cost for one game drive, or for the game drives for the entire year. In fact, 60 game drives times by the number of people in that drive, times that by the cost or price per person. This gives us 180,000 rands per game drive, excluding all other costs. It's only the revenue that is expected to be generated per game drive. Then after it says the useful life of the vehicle is 5 years, meaning when we are calculating the depreciation, which is not to be used in calculating our NPV, it will be 450,000 rands divided by 5, and this will be 90,000 rands as depreciation, meaning depreciation is 90,000 rands every year, wear and tear. In fact, depreciation, not wear and tear, because wear and tear is the language of SaaS. Then after it says yearly fixed cost including depreciation, meaning including the 90,000 of depreciation, is amounting to 205,000 rands, and yearly variable cost is 60,000 rands. So now these are the total costs that we have for this entire period. Total fixed cost 500, and 60,000 is the variable cost. So now we need to deduct in our fixed cost depreciation, because depreciation is a non-cash item, so it does not affect our cash flow. We don't pay it to anyone. Then I will say 202,500 minus 90,000. This gives us a total of 112,500. This is our total fixed cost, and our variable cost is 60,000. Let me also add that 60,000 to my fixed cost so that I get to my total cost plus 60,000. If I add 60,000, I get 172,500 as my total cost. Then I can minus 180,000. If I minus 180,000, I get 7,500. And that 7,500 is the cost that, or let me just reconfirm that. We have 202,500 minus 90,000. And this gives 112,500 of the fixed cost excluding depreciation. Then we have 60,000, and 60,000 is the yearly variable cost, and therefore now the total will be 172,500 as our total cost. Then we also have to take into account the sales, then we deduct that, but let me wait before I do that. So now that is the information that we have so far. Then let me look forward and see all other costs that are provided for this investment project. Then now we have the depreciation, which is calculated at 25% per depreciation 25%, or depreciation is 25% per annum on the cost price of the vehicle. So the depreciation is not just saying divide that by 450,000, it is 25%. So now that means our depreciation is not the 90,000 that I initially calculated. It is a 25% depreciation. So now meaning we have to go to the cost of the asset and to say the cost of the asset times this by 25%, then this gives us the real depreciation. Times this by 0.25, then this gives us 112,500 of depreciation. Therefore now I have to make an adjustment, minus 202,500, 202,500, meaning my fixed cost is 90,000 rands. My fixed cost is 90,000 rands. Then my fixed cost is 90,000 rands, meaning I minus my depreciation of 112,500. Then my fixed cost becomes 90,000. Then I say 60,000 plus 90,000, I get to the total cost, and the total cost will be plus 90,000. Therefore, now this gives me 150,000 of the total cost. Remember, here we multiplied and multiply, and that gave us 180,000. I was wondering why the answer was wrong previously. So we say sales revenue minus total cost. This will give us an amount of 30,000 plus 180,000. Therefore, now the net profit kind of is 30,000 per year. So now this is the net profit, meaning after I have deducted all the expenses. And I'll emphasize something as we proceed in this question. Depreciation is given there, and SARS revenue allows 5-year wear and tear on a similar vehicle. So the wear and tear of SARS is 5 years. So now meaning SARS allows wear and tear of 5 years, and they don't specify the percentage, meaning it will be just 5 years divided by the cost of the asset. So now wear and tear of SARS will be the one that is 90,000. So now meaning wear and tear according to SARS will be 450,000. Divide this by 5 and it gives us 90,000. So this is the one that will affect our tax. Although our weighted average cost of capital is 16%, this is the percentage that will be used to discount our net cash flows. And the rate of tax is 28%, while the net cash flows, and this is very crucial because our incremental cash inflation amount is at the net of the cash flows, meaning we don't increase sales separately and expenses separately, or fixed cost and variable cost. We take the net, which is 30,000, which was 180,000 minus 150,000. Then we get 30,000. We increase the net, which is 30,000, by the percentage of 7%. So now this annual inflation at the rate of 7%. So now this is what will be taken into consideration. And in this question, we have the net cash flow of 7%, meaning now we have to say our 30,000 of the net cash flows times this by 1.07. It will give us 30,000 times 1.07. This will give us 32,100 as the cash flow for year 2. And I want to record my net cash flow immediately in my table as they are supposed to be recorded. So now I can say cash flows now because this is my net cash flows already. In year 0, it is not recorded, but it's 30,000, beginning of the year in other words. But I'm not recording that because it will just confuse some of you. Then we start in year 1, and in year 1 we have 30,000 rands. Year 2 we have 32,100. Let me just go and check something that might need some explanation. It says net cash flow will increase annually in an inflation rate of 7%. So now this will be the 7% that we increase in year 2 going forward. Then we have recorded the cash flow for year 2, then we go to year 3. We multiply this by 1.07. Then this gives us a total of 343,000 or 34,347. Then we multiply this by 1.07. We get 36,751, and we multiply this by 1.07, and we get 39,324. So now these are the cash flows that are expected to flow into the business because of this project for the period of 5 years. Now we need to check if perhaps was there any scrapping allowance or sales value at the end of the useful life of this asset. Now let us look if perhaps was there anything of that nature. the sales value at the end of the useful life of the project. Sales value at the end of the useful life of the project. If was there anything of that nature? Not yet. Oh, they gave it to us. Yes, the vehicle will be sold for 200,000 rands at the end of the business venture. So at the end of 5 years we expect to sell this asset. So we have sales at the end of useful life, sales value at the end of useful life. At the end of 5 years we expect to sell this asset for 200,000 rands. So now we have to go straight to taxation expense. Then we can record taxation amount that need to be recorded. We record taxation. Then we know that in year 0 there is no other deduction, is 30,000. And in year 1, year 2 we have 32,100. Year 3 we had 34,347. Year 4, 36,751. Year 5, we need to take into account now the amount by which this asset will be sold for. Then we get a total of 200. Now in this case, when it comes to the calculation of taxation, we get to account for a total of 239,000. 324. We have taken into account the wear and tear. If you want, you can record wear and tear separately as a line item, where sometimes you'll find that it will be recorded like this. Just want to also show you a different perspective, which is 39,324, 39,324, 39,324. Then we record the 200,000 separately, which is the sales value. Sales at the end of year 5. So we can also have that point of view. Then we continue by saying 30,000, 32,100, 34,347. Then okay, before that we have wear and tear to account for. We have wear and tear to account for. We have wear and tear, and wear and tear is 90,000. We have wear and tear of 90,000. Wear and tear of 90,000. We have wear and tear of 90,000. Now wear and tear of 90,000 is taken into account. Then we get to the taxable income. We get to the taxable income. Taxable income. And our taxable income, just would like to start with the last one. We have 239 minus 90,000. Because I already have that, I get 149,000 in year 5, 324. Then I have 36,751 minus 90,000. For this one is negative, so there's a loss of 53,000. There's a loss of 53,249, and there's also a loss in year 3, 34,347 minus 90,000. There's a loss of 55,653, meaning we are not paying tax at the loss. 32,100 minus 90,000. This is 57,900. Then after we have 30,000 minus 90,000 will give us 60,000. Very easy. 60,000 times by 28%. Our tax will be 16,800. This will be savings. Then tax becomes now positive because we are not paying tax on a loss. Then we have 57,900 times by 28%. I normally forget to multiply this while I'm calculating. 16,212. Then we have 55,653 times this by 28%. This is 15,583. Then we have 53,249 times by 28%. That is 14,910. 14,910. The last one is 149,000. It's only when they make a profit because of that huge sale of the asset at the end of the useful life. 149,324. Times this by 0.28. Then there will be a tax that will be paid in year 5, 41,811. So that is the only time the company will pay tax. Then we copy this, we record under taxation. 16,800 is year 1. 16,800. Year 2, 16,212. 16,212. Year 3, 15,583. 15,583. Year 4, 14,910. Year 5 is the only time the company pays tax of 41,811. 41,811. So now from here we can get to our net cash flows. And I want to bring this across to your mind that when we are calculating tax, we take into account income statement items. And this is capital. This was working capital. So this amount of 50,000 should not appear in the figures when you are calculating taxation. So hence I did not take that into account because it's capital. Capital is not an income statement item. It is capital, which is an asset in nature. So now we then determine the total cash flows, 500,000. 30,000 plus 16,000 plus 16,800. This is a total of 46,800. Then we go to the next part where we say 32,100 plus 16,212. And this gives 48,312. Then year 3, 34,347 plus 15,583. This is 49,930. 49,930. Then we go to cash flow for year 4, which is 36,751 plus 14,910. And this gives us 51,661. And the last year we have 50,000 of capital. We have plus 39,324. We have plus 200,000. We have minus 41,811. The total is 247,000. 247,513. 513. And these are net cash flow. These are net cash flows. Now don't forget the 500,000 is negative, and we can also start with the discount factor, and our discount factor here will be 1. We have the weighted average cost of capital as 16%. Weighted average cost of capital as 16%. And if you remember in the previous question, we added the inflation here. And the reason why we added, because we were given the average annual inflation. This inflation is inflation for the increment of the net cash flow. Not to say it is an average annual inflation for all the products. In the previous question, we were given inflation increase for the sales, inflation increase for variable cost, and inflation increase for fixed cost. But there was a separate 4.7% of the average inflation for the year. But this is not average inflation for the year, it's average inflation for the net cash flows only. So hence now we will not add it to the weighted to get to the adjusted weighted average cost of capital based on inflationary movements. So that will not happen in this case because of such reasons. And now we then take into account the 16% as our discount factor. So now I just want again bring this across to your mind. This will be 1 over 1 plus 0.16 to the power of year 1. Again the same thing, 1 divide this by 1 plus 0.16 to the power of 2. Then you'll get all the decimals. That takes, just take into 3 decimal places, then after you are done. But I will just give you all the discount factors. So now at 16% we have in year 1 0.862, here we have 0.743, and we have 0.641 and 0.552. Then after we have 0.476. Then don't forget that you multiply. If you are using the manual approach, you don't have a financial calculator, you multiply here, and you multiply, and you multiply, and you multiply, and you multiply. After you have multiplied, then obviously 1 times by 500,000, you'll get the same 500,000. Then these figures will be after you have multiplied, after you have multiplied, after you have multiplied, after you have multiplied. And remember, all these figures are positive. So now the net will be positive. Therefore, you add all of them. You add all your cash flows, then you minus your cash outflow. Then the net of that will be your NPV when you are using the manual calculations. So now I'm using a sharp calculator, but at least I've shown you how to deal with the manual calculations. So now in my calculator, I just take into account cash before they were discounted, which is 446,800. For me, I take 48,312. Remember, this is not after discounting. I'm using now a financial calculator, meaning I am ignorant of this part. I'm not taking this into account. I'm taking my cash flow before they are discounted, because I'll put the discount factor in my calculator, punch it in my calculator. 930, then I have 51,661, and I have 247,513. Then what do? I just say cash flow year 0, cash flow year 1, cash flow year 2. Remember, if you have used the manual approach, you don't need to do what I'm doing now. Then we have cash flow year 3, cash flow year 4, cash flow year 5. Then after, I will just get to my NPV. I will get straight to my NPV. Then after, I will have my NPV here. Then let me punch it in my calculator in terms of the calculations. Then this will be the calculations. I need to know that my interest rate is 16%. Then I could also say that discount factor is 16% there if you're using manual approach. Then my NPV, I say minus 500,000, enter, 46,800, enter. Then I say 48,312, 48,312, enter. 49,930, 49,930, enter. 51,661, 51,661, enter. Then the last one is 247,000, 247,513, enter. Remember, if the figure is negative, you say negative that figure. But all the figures in year 1 up to year 5 were positive. It's only year 0 where it was negative. Then I would say second function, CFI. CFI is just below the comp button or above the enter button. Then after it says rate, under rate I enter 16, then I say enter, punch 16 and say enter. Then scroll down once it says net PV, net present value, then I say compute. Then it gives me net present value of 245,000 and it's negative. Be mindful of the fact that it's negative. Want to bring that across, it is negative 245,387. It is negative NPV. So now I cannot advise this company to take this project because their NPV is negative. So now the conclusion will be that, then when I'm concluding, I will then have to say SEMTOS should not invest in this new business venture because the net present value is negative. So that is the conclusion. Make sure that you do conclude because there is a mark for the conclusion. So now conclusion, because it's very short, let me just do it for this one in sake. Then I will say SEM should not invest in the new business venture, in this new business venture or in this project because the NPV is negative. Because the NPV, write it all, net present value is negative. So now that is the main reason why this should not be accepted. So this question was a bit of a short one in comparison to other questions, but also very important to note some differences, more especially the capital and other differences in terms of wear and tear and other things. And the annual inflational changes. So with that, guys, let me say thank you. I think this is the last question I'm recording on the capital budgeting. Thank you guys very much.